Invite out. Okay. All right. Invites out there. For those of you joining on the replay, you can fast forward to the disclaimers while we wait for the studio audience to come in, as is the case every week here. 10,000 global followers for yours truly. I am a 30-year veteran of Wall Street, tech, AI. I've known about Nvidia since 2002 as an AI player, and retired in 2008 by the grace of God, having come up from living in a basement, not a basement apartment, a basement, now living in a penthouse, having been retired. I can't believe it's been that many years, almost 18 years now. It's been 17 years since my first Seeking Alpha article. Company went up 7 bags and was acquired. And now, 2 hours just about every week, I come here and donate time to you, the mom and pops of the world who get ripped off by colleges, by CNBC. Yes, I said it. Okay, colleges do not teach you what you need to know. I graduated from Northeastern University with honors. Look it up. It's one of the top 50 institutions in the country. And yet, I lost money for 3 straight years after college in the stock market. I was a stock market loser. I was duped by the colleges. I was taken under the wing of a Wall Street mentor, somebody who was trained by a legend of Wall Street. And he taught me the real, what's real about Wall Street investing, how to really look at these things. And it's completely 180 degrees from what CNBC teaches you, from what day trading teaches you, from what the internet teaches you, from what social media teaches you. There's 10,000 clowns out there telling you what to do with your money. Guess who they care about and whose money they care about? All right. So we're just waiting for the studio audience to come in, share the live. We're going to talk about my largest position today. It is an AI name. But while we're doing that, let's get the disclaimers on the screen. There they are. If you continue to watch this show, or if you're watching this show, you acknowledge that you have read this or had somebody read it to you. Okay. And that's on you. I am not a registered financial advisor. Okay. Everything is laid out here. Okay. So nothing I say here constitutes investment advice, of course. All right. The information I'm providing is to the best of my knowledge as of the time that this broadcast, but it could change at any time, and I'm not beholden to updating that information. So that takes care of that. Now, I want to address one little thing. I always give little speeches here and there. I do things a certain way. All right. Whoop, let's go. Let's put on the chart here for now. Actually, where was it? Oh, yeah. Let's go back to this for now. That's fine. I do things the way I was taught. All right. The way I was taught turned me into a multimillionaire. The way I was taught allowed me to make multi-7 figures per year. Okay. And so I stick to what I was taught. This is not my way. This is the way I was taught. Yeah, put some tweaks along the way to optimize it, which has worked great. Up like, 180% last year. All right. No losing picks since my daughter was born almost 2 years ago in the official portfolio. Nothing's closed out in a loss. Right. So when somebody like this comes out into the internet and starts giving their wisdom out for free, you've got really 2 choices. Listen and learn, or move on. All right? I ain't here to deal with your way. I'm here to teach my way. There's a big difference. You want to deal with your way? Go ahead. Right? Go form your own show. Go do your own thing. I'm not here to deal with that. And good luck to you. That's fine. That's cool. Right? Maybe you're not one of the 10,000 clowns. Maybe you're one of the real deals. All right? It doesn't matter to me. All right? So enough about that. All that to say, somebody that was in one of my communities was acting up, thinking I was an a-hole. Listen, when you think everybody's an a-hole, you're the a-hole. All right. You were there doing things your way and saying that I was pushing my way on you. Yes, exactly, stupid. And that's why you're not in my community anymore. I told people, and this is the point of the matter, I don't care how many followers I have. If you saw my videos from the earlier in the year, the problem I had was having too many followers. I don't want this many followers. All right. So guess what? I'm going to be very quick to get rid of the ones that don't fit in. And that's all there is to it. I don't want to be one of those people with 50,000 followers, 100,000 followers, million followers. I'm not an influencer. I'm a stock analyst. I'm an equity analyst, a stock picker. Okay? You go do you. You can pump your stocks. You can use technical analysis. You can day trade. You can push all your stocks you want, but not on me. Get the F out of here. All right, let's go. We got a full audience here. Y'all know what that means. It's Friday. It's Money Mark. It's Stock Talk Live. We have a huge show. Okay? And yeah, there's the disclaimers again. For those of you joining late, we don't need that anymore. We're going to talk about the stock market quickly, but we have so freaking much AI to talk about. And for those who didn't join in earlier, I am a 30-year veteran of the tech sector. I used to get paid by Wall Street. $3,000 an hour was my going rate for my consultations. Okay? So it was like that. Jim Cramer paid me. George Soros paid me. If you watch the movie Dumb Money, SAC Capital, Steve Cohen paid me. And I was able to retire in 2008, okay, at the age of 38. And now here I am helping you guys out. So we focus on tech. We focus on AI here, right? We do talk about other names, but listen, AI is the name of the game in the stock market over the last couple of years. As I've been saying for a long time, AI is not a bubble. Hey, bro. Hey, bro. You were out here saying AI is a bubble. One of the clowns in my audience here who came this close to getting kicked out, but he's kind of cool, so I kind of let it go. What do you say now? Stupid? Huh? Watch what I have to say today and you tell me AI is a bubble. Dumb. Dummy. We got a lot to say about that. We're going to talk about earnings reports. We're going to talk about winners and losers. We're going to talk about what's going on in AI that is absolutely stunning, even to me, who's been a bull on AI for coming up on 3 years now. Okay? To the point where you might be surprised that even though Nvidia is near the red line, I've started to buy Nvidia again. Okay? For those who don't know, for you newbies out there, these red lines have been my sell targets on Nvidia. So that was a 27% drop. That was a 30-something% drop. And then it hit this red line here, and I said, get out again, and it's gone nowhere since. Up and down, up and down. So yeah, you could have made a little bit of money along the way, but it's basically gone nowhere since this red line point right here. Maybe you're up 2% if you didn't sell here. But guess what? If you did sell here, that was in July of last year. If you couldn't make 2% over the last 8 months in other names, much less my picks, I don't know what to tell you, all right? Because I've made that much in my money market money, right? That pays 4% per year. Hold on one second here. Here we go. I'm looking for my notes. And all right, so what do we got? We're going to talk about Anthropic. We're going to talk about OpenAI. We're going to talk about my picks. We're going to talk about Micron. We're going to talk about Supermicro, Dell, TSSI. But first, let's go over the macro super quick because it's just too much. I don't think we're going to be able to fit it all into the show. It's going to be crazy. I might have to come back on Monday to give you the rest of everything, but we're going to try to get through everything. Let's try it. Fear Greed Index is now down to, it's an extreme fear, 16. All right. Now, remember what I told you before. Anything over 75, the extreme greed, that's enough to be cautious, take money off the table, especially if we hit yellow alert levels. There's the yellow alert on the Qs. The Qs are now down since the yellow alert. SPY, the S&P, we hit Yellow alert here. The Qs, the S&P is down significantly from the yellow alert. What do we got? Down, I mean, significantly is 5%, right? But it is what it is. 5%, right? 5% over the course of 8 months. Instead of being down 5%, you could be up 3% in a money market account. That's an 8% swing. Just from that alone. Never mind if you've been in some of the picks that I've provided you with or just had your money elsewhere. Right? Gold, silver, you name it. Any number of those things over the last 8 months have done great compared to the market. And then, of course, the Russell, which was the last one, right? That was the last place that you could keep your money because the yellow alert didn't trigger back here like it did for the S&P. Here, back here for the Qs, but it triggered way over here. But now IWM, which represents the Russell 2000, is down 10% as we speak from the top. All right. So, boom. That coincided with some of the extreme. You see the extreme greed that occurred here back in July. That coincided with the yellow alerts that we had. And so it was just easy to get out. Get rid of your speculative names. Get rid of your wait time names. I kept a little bit of some of mine, and I definitely regret it at this point. And then hedge your bets. You can buy RWM. You can short stocks. Have some shorts. Have some hedges. Ask AI what that all means if you don't know, because I've talked about it a lot in the past. If you don't have your notebook and pen out and haven't been watching this show for a long time, I can't go back for everybody else, right? Boom, right? Getting rid of your speculative names, your wait time names, putting hedges in place, and putting the cash on the sidelines in a money market account has been phenomenal. It has greatly outperformed the market since I said all these things. But on the downside, real quick, fear, greed, right? Extreme fear gets worse than extreme greed on the upside. So once extreme greed gets to 75%, take money off the table. But extreme fear can get a little bit worse. So bottom line is today the day to pile into the stock market? Maybe, maybe not. I've definitely been a buyer this week, okay? I've been a buyer this week. There are names that I think are great buys. We'll talk about some of those. Right? But I've also, if I buy $100,000 of a stock, I'm shorting the market with $100,000. Mark, where are you getting $200,000 from? Dude, what I've been telling you, cash on the sidelines, in the money market accounts, so that you could take advantage of these opportunities. All right? But in terms of the market bottoming out, if I had to guess, I think we've got a little more downside. I wouldn't be surprised if we get to 10 or under on the fear greed index, right? And it really comes down to oil, Iran, that conflict. The best guesses that I'm hearing about is that they pull out in the next couple weeks. And the reason is that Trump has the midterm elections to worry about, okay? And it is March, and this is not helping the cause, right? So it's really about, are they going to pull back or are they going to put boots on the ground? If they put boots on the ground, this is going to be devastating for the midterm elections for the Republicans. So I would bet on no boots on the ground, which means the conflict ends in the coming weeks. Right? In the meantime, Trump has put measures in place. You've got strategic reserves of oil. You've got Iranian oil that's been restricted. You say, nobody's allowed to buy Iranian oil. Well, there's been a bunch of, that creates a surplus of Iranian oil. Those have been lifted for the time being. Why? To help suppress the price of oil, because, as I've said many times before, put it in your notebook, oil is arguably the biggest determinant of future inflation. You're already seeing it at the pump, right? Gas prices are going up. If the price of oil goes up, it impacts everything. What do you think runs the factories? What do you think goes into tires? What do you think goes into your gas tank? What do you think goes to virtually everything, directly or indirectly? Oil. So they're suppressing those prices right now to keep a negative economic reflex loop from occurring, so that the Fed doesn't have to raise rates. Things like that, because that's what they might tend to do in terms of inflation. Blah, 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 yap, yap, yap. Bottom line is it's not over yet. But if you hear that this conflict is over, you better buy, buy, buy. I don't care. The market would probably gap up 3 or 4% on that news. Buy, buy, buy on that news. Okay? if not ahead of time, as I'm starting to do. Okay, so last thing, 2-year yield spiking up. That indicates, right, and the Fed is basically, the thought is that the Fed's 50-50 to raise interest rates between here and the end of the year. Okay, I personally don't think that'll happen, so I would be shorting or I would be buying 2-year bonds, because the as that rate goes back down, those bonds will do well. But I could be wrong. I'm not a macro analyst, but I just wanted to go over that stuff. And of course, the GDP Now estimates and the blue chip consensus are aligned for Q1, looking at around 2% growth for Q1. So we're still in pretty good shape. All right, that's the macro. Let's move on to stocks, because there's just a lot to talk about. And we got to start from a high level to really understand how important AI is, okay, and what's happening in AI, and why I called somebody a dummy at the beginning of the show is quite simple. And it's because we are now seeing, not only, like I showed you the Tom Cruise, Brad Pitt fight on the roof video, right? And I was like, who was telling you 2 years ago that there's going to be an Avengers movie made entirely with AI within 10 years? 2 years ago. Yours truly. People say, you crazy. You're going to be, shut up. You don't know what you're talking about. You're not a 30-year veteran of technology, right? And I could be wrong, but you don't have the expertise to even challenge an expert, whether it's me or somebody else that I might respect, one of my colleagues, from that same domain. And what do we have now? We have what is effectively a trailer for a movie involving Brad Pitt and Tom Cruise out on YouTube. You know what I'm saying? It's not going to be a movie, but that was one guy in his basement that made that. So we've seen the progression of AI. By the way, Curie, C-U-R-I, Curiosity Stream, as these LLMs need more training on video, because they're seeing that the videos that are coming out, it's like Hollywood's scared, right? Val Kilmer, the late Val Kilmer, God rest his soul, his estate just signed a contract for Val Kilmer to appear in an upcoming movie. Oh, who said that would happen? Me. Guys like Tom Cruise, The Rock, anybody that people want to see in movies, they can die and still be in movies into the future because of AI. Okay? And the value behind that is tremendous, because instead of paying Tom Cruise $20 million to be in a movie, right? Tom, will you go through all the work to learn your lines, to learn how to act, to do these action scenes, et cetera, and we'll pay you $20 million, or we'll pay you $5 and just have AI do it. And Tom Cruise could do 10 movies at once if he wants, like that. So you could just understand the value of the technology that goes behind this, and understand that it's not slowing down. It's not even just staying the same. It's not just moving up at the same pace. It's actually accelerating to an even higher pace than before. And here's the proof, okay? I'm going to tell you a story while I leave this up on the screen. And it's a little hyperbolic. It's not exactly how it works, but it's going to give you an idea. 4 months ago, I'm using AI for free. It's not true. I was paying for AI, but just listen to the story, because it's pretty close to the truth, and it'll give you a sense of scale of what's happening with AI now. 4 months ago, I'm using AI for free. Okay. 3 months ago, I decided, man, I would get more out of this AI if I pay for the subscription, $20 a month. Who cares? I'll try it out, right? The $20 version is, wow, oh my God, this is great. It's beautiful. Only one problem. I get some hallucinations once in a while. So let me pay for another AI, and I'll have them fight with each other, right? If one says something, I'll just feed it into the AI and say, is this accurate? And if they both agree, then it's less likely that it's a hallucination. Okay, so I go from paying $0 to paying $20 a month to paying $40 a month. And that works so well that a few weeks ago, this is a true story. This is where the story gets real. I decided to go all out. I'm paying for now Perplexity Computer. Okay, that's what it's called, Perplexity Computer. I was told this is the creme de la creme. This is the boom, right? $350 a month. Okay, bet. Let's try it out. If I don't like it, if it doesn't make me go wow like all the other ones did, I'll just get rid of it after a month, right? So I sign up and they give you 15,000 credits. This is not like the regular, you subscribe, get the subscription and it seems to be unlimited, but they'll push back sometimes, right? Whatever. No. This one has specifically 15,000 credits and it's a meter that depending on how you're using it runs down towards zero at a faster, slow pace. All right? Stay with me, y'all, because this is where it gets really big. They gave me 40,000 bonus credits on top of my 15,000 per month allotment because, hey, you're a first-time user. We're going to give you a 40,000 credit bonus on top of the 15,000 that you get per month. Bro, Perplexity Computer is so amazing that I blew through the 15,000 credits in 1 week, another 15,000 credits in another week, and another 15,000 credits this week. I've blown through 45,000 credits in 3 weeks and feel like I've gotten my money's worth. Translate that into monthly math, and it means that I could expect to be paying over $1,000 a month going into the future for what Perplexity Computer does for me in helping my stock research, in helping with things that are going on in the world. It can take applications that exist on the internet and go into it and interact with that stuff and analyze what's actually the immense data sets. It's incredible what it can do. So I've gone from zero. I'm going to tie a bow on the story now, right? Here's what it means for all y'all. It means that I've gone from zero to 20 a month, to 40 a month, to $350 a month, to the expectation of paying over $1,000 a month for AI. And what does that mean for OpenAI, for Anthropic, for all of these hyperscalers? Take a look at the screen, okay? Anthropic's revenue run rate of growth went from zero at the beginning of 23 to 100 million at the beginning of 24, 10x'd to $1 billion in the beginning of 25, and on the tail end of last year was at around 12 billion run rate. And as of a couple of weeks ago, it had gone further up to 14 billion. And within 2 weeks, this chart became antiquated because here's the other chart now when I talk about the title of this video being AI Wars. Look, oh, AI is a bubble. No, AI is not a bubble. AI is actually hockey sticking from a hockey stick level. Okay? This shows Anthropic at $19 billion run rate of revenue, and that doesn't even account for the fact that if you're on a $12 billion run rate, that's $1 billion a month. Late last year, Anthropic was doing $1 billion a month. Do you know what they did in February? 6. Do you know how many companies I've ever seen go from $1 billion in revenue 1 month to $6 billion in revenue a few months later? 0. Goose egg. This is going to be an absolutely stunning IPO. I mean, look what's happening to their revenue. And OpenAI is kind of keeping up. All right. Anthropic's closing the gap, by the way. That's the AI war that I talk about in the title of this video. But the fact of the matter is both of them are going parabolic in terms of revenue, not just usage. This is actual people willing to pay money for what these things can do. So when you ask yourself if this build out is what I've been calling it, not a bubble, a build out of infrastructure for AI starts generating this kind of revenue, why would you think that the amount of spending that they are planning, the amount of CapEx that you hear, that's what you've been hearing, right? CapEx, Google, Meta, Microsoft, Amazon, these big CapEx numbers, there's a reason for it, stupid. They're not dumb. They're not throwing this money down the drain. They understand what AI is capable of doing, and they're trying to become the monopoly holders, the oligopoly holders of this future that we have. As scary as it might be in some regards, because people are losing their jobs. What's crazy, Jensen Huang, CEO of Nvidia, they had their big conference this week. One of the things he said in the midst of that conference, most of his company, like the 75% of his company, are engineers, people building up the technology, the Nvidia technology stack, right? And it's not uncommon for him to pay $500,000 a year for the kinds of people he wants to hire, $500,000. And he said, if the AI bill for that employee is not at least $250,000, we got to sit down and have a talk. I said at least. In other words, he expects and requires his employees that he's paying $500,000 a year to spend an additional $250,000 a year on AI because of what it does in terms of multiplying the value of those employees. I cannot tell you enough how bullish that is for AI. And why I started to buy Nvidia again, despite the fact that it is sitting at really close to my red line level. I mean, this is a red line that goes back a long way. I've talked about it for a long time, okay? And I might be wrong. I was wrong about Kraken, right? We're going to have the big Anduril IPO coming up, and Kraken went right through my top line and kept going. It's tripled since hitting my top line. I don't expect Nvidia to triple, by the way, but I do think that owning shares of Nvidia at these levels for me is a better bet than having that money in the money market account. I'm not putting all my money market account in Nvidia. Don't get me wrong, but I took some of it. I'm like, you know what? I got to put a little bet on Nvidia, and maybe I'll increase that bet if Nvidia becomes cheaper. But I got to restart my Nvidia position despite this, because I'm not sure that this red line is right. It's been right so far, but it didn't account for the fact that AI might suddenly start going to a whole new level that blows everybody's mind. All right, so there you go. That's the big picture, all right? And I'm sorry for spending so much time on it, but it is so very important for each one of you to understand what is happening here is the most stunning thing I've seen in AI since ChatGPT came out, okay? This is equally stunning to me as the first time I saw ChatGPT in action. All right, and there's the Nvidia chart, and there's what we might be looking at instead, right? There's what it looks like here on the on my chart with the risk reward lines, fundamentals. But this technical chart of Nvidia's movement since 10 years ago, this may be more accurate and points to Nvidia going to like 250. And to me, Nvidia at 250 makes more sense than Nvidia going down to 150. All right. That's where I am with that. All right, let's talk about some more stocks. On the flip side of all this. Oh, by the way, if you like that somebody like me with the experience, being retired, making all this money, not having to be here, right, gives this away to all y'all 2 hours a week roughly with no sponsorships, no advertisements, nothing. I do not accept, in fact, I do not accept money for anything in life anymore, okay? If I like it, I do it for free. If I don't like it, I don't do it. And I don't care how much money you offer me, I'm not going to do it. And that's been great. I've been doing that for over 10 years now, and I've made more money somehow or the other. I think maybe, I'm starting to believe in karma, that God rewards people who give, okay? Because he's given back to me much more than I ever had before I started doing that. If you like that, just give me the thumbs up. If you want to Find out when I'm live, hit the subscribe button and the notification bell, right? Other than that, we are going to do Q&A today. The only thing I ask, if you put a question in the queue, is to put your question mark. In fact, put 3 of them. Makes it easier for me to see at the beginning of your question. And do not put question marks in front of a statement. I don't like that. It's not cool. Don't trick me into reading your posts. I read all the posts after the show. I'll kick you off. I'll ban you from ever saying anything again. Then you'll never get Q&A here again. All right? I don't tolerate BS on this. I don't need you. And I'm talking to people that would do that. Not the rest of you. I love all y'all. All right, Super Micro. Yo. Remember, Money Mark doesn't give you many shorts. Super Micro is one of them. Not right here, but right about here. I gave this to you as a short. I remember that summer very well, and I remember that drop very well, and here we are back here again. Funny enough, this white line could have probably been brought down to here in the wake of the last scandal, and here we are approaching it again. Big problem. Chip smuggling allegations. Okay, I haven't been able to fully ascertain the implications of this, but Supermicro has been a sketchy company to say the least for a long time. I don't want to get sued, but you can see the research I did back then that said this is absolutely a slam dunk short, which is what it pretty much needs to be for me to call it a short. But what I'm thinking this 31% decline in the stock might be all about is if they were complicit in smuggling chips to China, maybe the United States says you can't do business here anymore, and then they're done. Okay, that might be what's getting priced into the stock, because the people that got in trouble over this, I don't know, like you've got 2 different things. You've got people and then you've got companies. They're 2 different entities. So somebody at a company can get arrested and it doesn't mean anything for the company as an entity. Well, the stock's acting like the entity's in trouble, which makes me wonder about that. And you see Dell up 4%. Dell's a monstrous company. And by the way, right, we're down 2% on the Russell. We are down 2% on the NASDAQ. We are, let's see, down 1.6 on the S&P 500. Right? And yet, Dell is up 4.4%. TSSI up 1%. Better than a kick in the ass. All right? I'm not bullish on TSSI. You remember, right? I was the first person on the planet to prove that they were doing business with XAI at $2 a share and drew these risk reward lines. And people like, Mark, why is your green line above where the stock is? Because that's where it belongs. If you've learned how I do things, these lines are not technical. These are fundamental lines of value. Ranges of value of what a company should be trading for depending on how many cylinders they're operating on. And I determined that even if this company was not operating on many cylinders at all, that it's still, based on what it was doing and what I found out and what I proved, should be worth at least about $4 back when the stock was 2. It went to 4. And then 6, 8, 10, 12, 14, 16, and boom, it got pretty close to the risk reward line. Good enough for government business. Sell, we put the sell out. Right? And the stock didn't drop because of me, but it dropped because of the company's performance, all the way back down to 6, pretty close to the green line, close enough for government work, right? And for those of you who got back in the 6, 7, 8, whatever range, or maybe waited for this little breakout of the downtrend, well rewarded, because the stock more than doubled back to 20, at which point I'm out again. And then the stock kept going to 30. And people were laughing at me. That's cool. You don't understand. You can make money doing that sometimes, but you're not going to make money on that every time. And in fact, you could lose more money than you make doing things like that. That's what's called an optimized methodology. My methodology is optimized. What that means is if you learn everything about what I teach, and then say, I'm going to do it more aggressively, you will get a worse result. If you take what I teach and say, I'm going to do it more conservatively, you will lose more money. You will not perform as well because you have made it suboptimal. If it's already optimized, then being more aggressive or less aggressive, both of those factors make it less optimized. That make sense? Hope so. So anyways, bottom line is I got bearish around here because of what Dell did in their Franklin, Mass facility where I used to live. Not in the facility, in the town. And it convinced me that Dell is just using TSSI for overflow work. That's not a good position to be in, especially when you are a company that derives 97% of your revenue from that company. TSSI gets 97% of its revenue from its largest customer, their 97% customer, okay, who is also their largest competitor. That is problematic. And it proved problematic when they reported their results in Q3. The stock tanked, got all the way back down to about 7. And somewhere along the lines, right, I got confirmation. I already knew this because I've been following Dell for 30 years. Right? I've been covering Dell for 30 years. I know how Dell operates. I already knew this was true. But then I actually got proof. Dell contacts admitting, yeah, that not even admitting, just duh, what do you think? Of course, that's what we use TSSI for. TSSI won't tell you that because they're not supposed to, really. They're not supposed to believe it. They're not supposed to tell it, right? They're hoping to be something more, but so far they're not. They talked about expanding beyond Dell. It's been a while, folks. We're coming up on a year since the talk about that came up and still nothing. It's not a surprise, all right? But I did tell y'all that the data points were lining up for a great Q4 for various reasons. I won't repeat now because for the sake of time, and told you there was a really good chance they were going to give us a great quarter. And if we zoom in, you saw, boom, the stock ran into the quarter, gapped up on the results. I was like, this is a trade and only a trade, and Money Mark doesn't give you many trades. But if it's a trade, as soon as the news comes out, you want to be out, because the second the news is known to everybody, it's no longer a trade. And it wasn't an investment before, and it's not an investment now. So the trade is done, the investment doesn't exist, boom, we're out. And that was perfect, because if you did get out on the open, as I got out at 13, I think pre-market, it opened at like 14 or so and has done nothing but down since. And now it's actually down for the day for whatever reason, but only a little bit compared to the rest of the market. But if Dell benefits, if Supermicro is banned from U.S. business, that is good for TSSI because, and by the way, what I said earlier is good for TSSI. I'm not getting involved with TSSI because of the way their business is structured. I don't think that's a good risk to take. There's other ways to make money. But if you heard what I said earlier, then you should be bullish on AI almost across the board. But there are exceptions. Okay? You got to be careful about, there's risk and reward. You don't want to buy anything AI. You want to pay attention to risk and reward. That's what I teach every week here. That's why I told you to stay away from Nvidia to this point, because the risk reward just wasn't good with it up here at the red line. Yes, I'm starting to dip my toe in the water because this line might be wrong, but that is based on information that's new. All else being equal, you want to buy things when they are at a better risk reward level. Okay, let's keep going. What do we got here? That's Supermicro. Micron. Blowout numbers. I'm going to keep this quick. All right? Ahead of the quarter, and you remember I gave y'all Micron at 100. Okay? I got out way too soon, of course. Like 100 to 200. Doubled again to 400. And ahead of the quarter, which was announced right here, ahead of the quarter, the stock was ripping. Okay? And before the quarter was announced, I went out to my contacts in the industry to find out if this was a stock that I should play for the quarter. And if I saw something like I saw on TSSI, I would have told y'all, but I didn't. Here's what I saw. I asked one of my contacts, what is Wall Street expecting for Q2 in terms of price increases? I don't even care about Q1. I mean Q4. Q1. Q1. Sorry. What is Wall Street expecting for Q2 pricing? Because they are now about to announce Q1, right? Oh, jeez. Hold on a second. Let me get this straight. It's a blowout quarter. Because I got the information. Just having a little hiccup. Oh yeah, February quarter revenue, right. So the February quarter, I didn't care what they were going to announce for the February quarter because everybody pretty much knew what that was going to be. I know the Wall Street estimates were low and they blew them out and all that stuff, but the whisper number was out there because you have a good sense as to what they're spending. The distribution channel, I got distribution channel contacts, they tell me what the pricing is out there. So if you know what the capacity is and they're running at full capacity, and they are, we know that, right? If they're not running at full capacity, then you have to know what capacity they're running at, and that's almost impossible to figure out. But if they're running at full capacity and you know what full capacity is, you just have to multiply it by the average price of the quarter and you know what the quarter is going to look like. I knew it was going to be a blowout, but I also knew that Wall Street knew that too. So what I wanted to know was, does Wall Street know how big next quarter is going to look? So I asked one of my contacts, what's the Wall Street expectation for price increases in Q2? And at the same time, I asked my industry contacts, industry experts, what pricing they're hearing from the actual vendors for Q2. Okay? And lucky for me, one of my contacts had just spoken to Micron, Samsung, HK Hynix, and they had told him, the companies, that pricing for Q2 is plus 80% over Q1. Wow. Q1 was 80% more than Q4. Like, this pricing's going cuckoo. 80% up and now 80% up again. You've seen it. If you go to try to get a 1 terabyte of memory from Best Buy and you want to play Grand Theft Auto or whatever, you were paying $89 at Christmas and you're paying $389 now, if you can find it, right? That must be bullish. No, wait, dummy, because you have to find out what the expectation is. And so when my guy got back to me, the expectation was 80%. So Wall Street was expecting 80%. The industry is saying the fact is 80%, and therefore there's no meat on the bone. So I didn't make a play, and I didn't tell anybody to make a play. And so what you had was a buy the rumor, sell the news event. And that's exactly what happened there. Okay? So be careful, folks. All right? There's a lesson in there for you. I am not in Micron. I don't plan on being in Micron anytime soon. This is like a historic level of pricing for Micron. Okay, going back to the 80s, we've seen these booms and busts before, and they are on the boom side of the equation. Yes, it can go up further. Could it get to 500? Yes. In fact, there's a good chance. There's a decent chance that it does. And why? Because that 80% in Q2 might turn into 80% in Q3. And maybe people aren't expecting that. Especially given what I said earlier in the show about AI taking another leap forward, right? Capacity isn't easy to come online, but the risk reward is not that great from these levels. So I'm not telling you that Micron won't go up. I'm telling you that I don't like the bet. All right, big difference. All right, let's move on. More AI. We're going to keep it quick on Intellicheck. They reported a great quarter, and the stock is up 16% as we speak. Okay, this is a stock that I got out of on the big spike. Remember, we had this big, huge move, right? Last quarter. It was an official pick. It went berserk. And then that a-hole Money Mark pulls the plug. Why, Money Mark? Why did you say to sell at 670? Because Money Mark just sticks to the rules. It's not my decision. I'm doing this check boxes and there's calculators, and they do all the work. And at the end, I look at it, and the check boxes and calculators tell me what to do. I don't really make a lot of decisions, right? I just follow the rules. Simple. And so we get out. The stock drops all the way from 660 to 460. And then they announce a great quarter. The stock ripped as much as 30% today on that quarter. Here's the problem, though. Okay. Two things. One, retail is weak. It remains weak. It was not pretty. Two, there's a good chance that quarter had some extraordinary circumstances pushing those numbers up to where they were in that quarter. The banking business, they won a new customer worth high seven figures, so that was bullish. But the retail, bearish. The fact that they had some extraordinary items helping the quarter, in my estimation, bearish. And then they took social media out of their forecasts completely. That's Facebook. They started talking positively about Facebook last quarter, how they had gotten 100,000 and they expected at least 200,000 and they could be on their way. And I told you, if Facebook goes full bore with this thing, it's probably at least $3 million a year revenue, and the stock could really, really rip. But it's not happening. They took it out of the forecast. I'm not saying it's not going to happen, but for them to take it out of their forecast denotes a level of a low level of confidence that we need to be wary of. Okay, so I am not inclined to buy the move, to buy the good news on the quarter. I'm not inclined to reinitiate coverage on the stock at this time. Doesn't mean I won't at some point in the future, but as of right now, this was a great result. Congrats to them, right? But I don't think the news, just like last quarter, it's crazy, right? Because last quarter I was like, this is great. This is a great quarter, but it's not as great as it looks. It's not a plus 50%. It doesn't justify a 50% move in the stock. I'm taking my money off the table. Similarly, I don't think this quarter justified a plus 30% move, and now you see the stock down to only up 15% on the day. And frankly, I wouldn't be surprised. That's fair. It's fair. But fair doesn't excite me. I like bargains. I like great stocks at great prices, not good stocks at good prices. I want to give a shout out. This is Techogen, TGEN on the screen. I told y'all a while back that I was looking at this company and I was positively inclined. Okay? But I was still doing my research. So I continued doing my research. And when I completed my research, I said, it doesn't pass. It doesn't meet the criteria. Third-party industry experts are mixed on the story, and I actually have a big problem with the story with regard to what problem they solve and how many customers might even need this solution. But Mark, they're partnered with Vertiv. Yes. And I'm sure that pistachio cherry milkshakes are on the menu at McDonald's. It doesn't mean anybody's buying them. You know what I'm saying? That's what you're dealing with here. And so a partnership, you guys completely put it in your notebook. People completely overestimate partnerships. You got to actually see a partnership do something first. And I'm going to show you something later in this show, an AI name that has a partnership that's doing something. This one hasn't been. Stock has gotten smoked. But what I want to do is give some credit to Geo Investing. Shout out to Maj. He put out a good article here. It's for paid subscribers. Sorry. You got to go behind the paywall, I guess, to get it. But it was very good research. If you're interested in Techogen, I would recommend it. I don't think it costs much to subscribe to Geo Investing. I had the article on my phone. I guess I'm subscribed on my phone, but not here. It was a good article and shows some maybe rays of light for Techogen, a stock that has done pretty damn poorly since I told y'all it didn't pass my tests and to get out. Okay, that was the right thing to do. And now maybe there's an opportunity from these levels. I don't have time to look at it right now. and maybe I will. I'm going to reread what Maj had to say when I have time, but I just wanted to share that with you and shout out to Geo Investing. IZEA. This has been a stunning turnaround. Great turnaround in the business that they're undertaking. The quarter itself didn't look great on the surface. Okay. The year did, but the quarter looked bad. Okay. 6.1 versus 9.8. Now hold on, because just like the case with IDN, when the quarter looked better than it actually was, if you know what you're doing as a professional stock analyst, I can tell you that this quarter was way better than what it looked like on the surface. Okay. And here's why. Forget about these numbers, because these numbers are not only 3 months old, they're even much more than that, right? Because this was a Q4. It's March 20th. Q4 started on October 1st of last year. Almost 6 months ago was the beginning of Q4 for IZEA. So first of all, some of this data is over 6 months old, but it's even older than that, because from the time that they book business to the time that they recognize revenue on that business is 6 or 7 months. In other words, some of the revenue that they booked in this quarter, not booked, but reported, some of the 6.1 million was from business that they booked upwards of 12 months ago, a year ago. Okay? And this, my friends, is why companies like Salesforce.com and Workday and all of these SaaS, software as a service companies, trade not on the revenue that they announce for the quarter, but on their bookings. This is why Air did not move up on their revenue because it wasn't exciting. They moved up on the bookings because the bookings lead to revenue in the future. And that is what determines the value of a stock, not the past, but the future. So anything that tells you something definitive about the future is the most valuable information you can get. Listen again. Anything that can tell you something definitive about the future is the most important information that you can get on a stock, because it definitively tells you something about the future, which is what the value of a stock is based off of. Okay? And from that standpoint on IZEA, the bookings were over $10 million in the quarter. Not only does that far exceed the $6 million, it also exceeds the $9.8 million they reported in the year ago quarter. And it, most importantly, was a huge increase over the bookings they had in Q3. Now, one thing that analysts do is look at sequential results. So what I did was I looked at Q3 bookings and the new Q4 bookings number. Big move up. But let's look at last year's Q3 versus its Q4. Because if last year's Q4 was equally impressive versus Q3, then it's not so impressive to see it happen again this year, because that's just what happens every Q4 versus Q3. Well, I looked, and what I found was an impressive movement from Q3 to Q4, but not nearly as impressive as you saw in this Q4. Not only that, but if you listen to the earnings call, what you heard from management was that they believe that they are now on solid ground upon which they can grow. We've been waiting for that. Right? Because they got rid of a lot of their business. They got rid of all the bad business. They had some business where they would have $1 million in revenue, and that $1 million of revenue cost them $2 million of expenses. That's not good business. So they decided the new CEO, Patrick Venetucci, okay, who comes from a legendary firm, a firm who invented Tony the Tiger, invented the Jolly Green Giant, all right? That kind of level character came in and said, this company is doing bad business. This is business that we wouldn't do at Leo Burnett. And he got rid of it. So what happens to the revenue? It collapsed. But what happened to the profitability? It went through the roof. And that's where you saw this headline with the big $19 million profitability swing on $31 million in revenue. Who does that? Who gets 19 million of extra profit on less revenue? The revenue dropped from a year ago. Last year was 36 million. This year was 31. But the profitability is up 19. Well, that's what happens when you get rid of unprofitable business. So it's okay that they let the revenue go down because it markedly increased the profits. Okay? And now they're booking more business at a faster rate. Okay? In a market that is, I showed you the Wall Street Journal article last week, right? In an industry that is going ham. Okay? You can go back to last week's stuff so you can hear more about that. But it's the creator economy. AI is making it so easy for influencers on social media to make content that's as good as a Super Bowl ad. That's as good as a blockbuster movie. So now they can compete. Leo Burnett is one of those old school firms. Like, Tony the Tiger. We used to watch Tony the Tiger on TV commercials. The Jolly Green Giant on TV commercials. Leo Burnett's the old school guys that would design a marketing campaign, invent something like Tony the Tiger, create the commercials. They got people internally that do this and the video cameras and all that, and they produce all this content. It's expensive. Think about it, right? That sounds expensive. It is. And then that commercial goes on TV. That's dead, y'all. I'm sorry. I know some of y'all still watch TV, right? But that's not the way of the world anymore. The average person in this country is like 38 years old. And millennials are upwards of 46 years old. So the millennial generation, 46 years and back. If you are over 46, you probably don't apply for this. But if you're under 46, you probably do. This is the social media generation. Okay? Most of the United States, right? I said 38 is roughly the midpoint of the average age of the United States. But everybody under the age of 46 is part of the social media generation. Social media is taken over. Social media advertising is more important than TV advertising. You look at the trade desk. This was a rocket ship. This was a beautiful company until it wasn't. Okay? Well, you've got, and as a result, the people who are the influencers of social media have the advertising power. But now they also have the same power of creating great content, great advertising as a Leo Burnett. And IZEA is the company that brings the companies together with the influencers. They're the important middleman, as I showed you on the Wall Street Journal report article from last week. Major. Okay? This is what they do. Also on the call, they said a few things that were very important. The buyback program. They seemed to hint at that they would start buying back again. And they also said that they didn't do any buying back last quarter. Well, that sounds bad, right? Well, it's not. And here's why. Because buyback programs have a window. Okay? And the window is from 2 days after you report your quarter until 2 weeks before your quarter ends. That's when you do buybacks. Okay? So when IZEA announced their quarter, right about here, they could start their buybacks again. But the stock was at 536. And by the time we got to within 2 weeks of the end of the quarter, December 15th, the stock was still 485, 483. There was, for them, it wasn't worth it to buy back shares at those prices because they were enjoying prices closer to $3 and $4. They didn't want to pay $5. They want to use that buyback on $3 or $4 because otherwise they can use that for acquisitions that are accretive to the business. And CEO Patrick Venetucci is very well adept at doing that. Okay? That ends up giving more value to the company than even buying back shares. Right? So they didn't buy back in the third quarter, and that's probably why. But now with the stock back down here, not only has the company, but the CEO has hinted at buying shares. Okay? So you got a buyback. You've got the market dynamics. You've got the bookings, all moving in a positive direction. So who cares what the quarter looks like? All we care about are the bookings and the business trends that push things forward. And that's what we got out of these guys. And I know I'm missing one thing here because my brain is telling me there's one thing I'm missing. Oh yeah, $3 in cash. They have $3 in cash. So you're not paying $3.63 for the stock, you're paying 63 cents. That's an enterprise value of like 10 million. If this company was a private company, if this was a private company getting venture capital investors, they would probably be getting, instead of 60 cents per share on their rounds of funding, it might be $6. And $6 plus $3 of cash is $9. That's where this stock could be if it was a private company, based on the private market comps. The companies that do similar things to what IZEA does that are private are getting those kinds of valuations. Okay? So there's an opportunity here for the stock to go closer to 10 than 350, and yet they have $3 in cash, which means you're basically risking 60 cents. Yes, I know. If they make a bad acquisition, they spend $1 of cash, then that could be $1 of cash down the drain. I think it's more likely the opposite. Okay, because they have net operating loss carry forwards. What's that? That's a tax asset. That means they've lost so much money in their past before Patrick became the CEO that they don't have to pay taxes any time in the foreseeable future. So they acquire a company that comes in, it's profitable, they incorporate it into their own business. Guess what? The taxes that that company was paying goes down. The employees that they were paying goes down, because when you acquire a company, you no longer need that CEO, you no longer need that CFO, you no longer need the receptionist, the accountants, because you already have all that. Okay? So I think if you acquire a company, you can write this down if you want, that has $10 million of revenue and $1 million of profits, and you pay $15 million for that company, that you could very quickly turn that $1 million of profits, because of the tax advantages, because of the operating synergies, because of the cross-selling, into a company generating $2 million of net income. And you paid 15 for that. That's a PE of 7.5. Instant value creation by acquiring a company. Okay? I think the odds of that are greater than them messing up an acquisition. So let's just say you could be right, I could be right. And we'll just say that the cash is the cash. The $3 of cash is worth $3 of cash. And what you're paying is 60 cents. And therefore 60 cents is your risk. And your possible reward is $6 of upside. You have a 10-to-1 risk reward ratio in the scenario I just gave you. Okay? I've been a buyer of the stock. Matter of fact, I promised myself earlier and I didn't have time to. I'm going to go in right now. And I'm going to be locked out. I have a 72-hour lockout that I'm imposing upon myself publicly as I buy shares of the stock right now, place some orders, and I'm paying more, obviously, than I could have paid before the show started, but I forgot. The day got away from me, and I'm looking at this, and I'm like, you stupid, you idiot, you forgot to buy your shares. So I'm going to buy them now. It's an extra 3%. Big deal. The stock could go up 100%. So, you make mistakes, you pay for them. Boom. There you go. That's IZEA. AI. We talked about Identiv already. We're at the top of the hour. So you know what I'm going to do is we've got a lot more to talk about, including my largest position, but we're going to take a break in the action to answer some Q&A, and then we're going to come back on the rest of these AI names, starting with Gatekeeper, in just a minute. a few minutes because we're going to answer some Q&A. I won't answer Q&A about anything I plan on talking about on the show. We'll save those Q&As for after. Let's see. First question in the queue. If you haven't, by the way, if you love what the content that I'm providing with you, a 30-year veteran of technology and AI who's been telling you for almost 3 years, AI is not a bubble. Told you to buy Nvidia at 42 and told you to sell Nvidia at those higher levels before it went down on multiple, three occasions now. Okay? Just give me the thumbs up. And if you want to see me every week, hit the like, subscribe, notification bell, all that stuff. If you haven't mentioned it by the time you read this, I love that. Thank you. That's very considerate. See, this is, some people actually appreciate, right? If you haven't mentioned it by the time you read this, what are the other near-term catalysts and risks for Identiv and IoT in general? I haven't spoken about Identiv yet. We will, okay? And the risks, I'll put that on my notebook to talk about it. Catalysts and risks. We will talk about both of those things. Where do you fall out? Where you fall out of a stock due to management breaking trust, would you consider going back if that person leaves? Electrocore. Yeah, I mean, of course I would, right? But here's the problem, is that the trust that was broken, it wasn't just broken trust. It's what the actual facts were, right? The broken trust were, let's not call them lies, let's call them mistruths. Right? There were assumptions. There were key assumptions that went into my valuation analysis of what eCore was worth and what kind of business it was, what kind of barriers to entry it had, what kind of flywheel, a positive flywheel it might have. And the problem is that when that trust was broken, I also got the real information and I had to redo my calculations with regard to how strong a business is this and what is it worth. This is why it's so hard to go back to somebody who breaks your trust, because they cause you to make the wrong calculations on what a company is worth. And those new calculations said, not just numerically that the company wasn't worth what it was going for, but also that the strength of the company was severely off of what we were led to believe. We were led to believe that they've got some great business in the Veterans Administration, the VA hospitals, that they were getting more and more hospitals, which was true, and that they were hiring more and more salespeople to attack that opportunity, which was not true. And the reason for that, I believe, is that the new hospitals that they were getting into in the VA weren't producing sufficient revenue to justify the existence of a dedicated salesperson there, which is why they stopped hiring salespeople and it in fact went backwards and had their sales force get smaller. If they don't have that beautiful dynamic of the VA growing so fast that you have to add salespeople, and instead it's not a new VA hospital, does not equal new revenue, does not equal more salespeople, that's a completely different business. So I don't care about stock price with a company like this, because to me, this is not a great company. If you don't have a monopoly on the VA or an oligopoly on the VA, then you're just another vagus nerve stimulator on the market, and just go to Amazon and see how many you find before you run into one of theirs. It's too competitive. Next question. Mark, are your risk-reward charts somewhere that you can access them that shows that are fairly current? Yeah, I've got to, somebody in my community, please remind me to put the links to the risk-reward charts in my disclaimers. Okay, so I think that used to be in my YouTube disclaimers on this video every week. I use the same disclaimers every week. I need to add the links to the risk reward charts to the disclaimer so that every week that appears. Great question. Thank you. Somebody remind me of that later. We got a lot of comments in here. Hopefully there's no trolling because I will kick you out. I'm looking for questions. What is your opinion on co-packaged optics for data center, and as it is totally different value chain? Yeah, I talk about what I talk about. That's a phenomenal question, by the way, but I can't answer every random question. I have to answer questions about things that I discuss on the show. Okay, so we're not really talking about that subject on the show this week, last week, in general. So it's kind of beyond the scope of this, just for the sake of time. Thanks. I love you too, guys. We got lots of great comments. I love those comments, by the way. There's nothing I love more than hearing from people that they appreciate what I do and the success they get. I still get messages coming in on the regular. Mark, I just hit my first 500,000. Thank you. Mark, I just hit my first million. Thank you. Things like that. I love getting those stories. Keep them coming because they keep me energized. Where do you see all the AI companies are going to get the energized compute they need? That's a phenomenal question. It's a huge problem. Huge problem. Where are they going to get the energy? Turbines, like the infrastructure players that provide the energy infrastructure are backlogged. Some of them to 2030 with orders. It's a huge issue, and it's actually holding back AI. So for those of you who are talking about AI is a bubble, no, not only is AI not a bubble, it's a build out, but the build out is being governed. You ever hear of a governor? I had a BMW 325. It was my first real nice car. And it had a governor on it. So when I, young guy, right? Not following the law, open road, big long stretch of highway, nobody on it, 4 lanes of no cars at 3 a.m. Let's see what this puppy can do. I was not drunk. 4th gear, went up to about 120 miles an hour. Let's go to 5th. Boom, and see what this thing can do. 125, 130, 135, 135, 135. What the F? The RPMs aren't maxed out. And it's not going over 135. What the F? It had a governor on it. It's something in the mechanism of the BMW that wouldn't allow it to go faster than 135, even though mathematically it was capable of going about 156 without risking the engine. Okay? The energy that is lacking from the markets right now, the amount of energy that these hyperscalers want and need for these data centers is right now a governor on their ability to scale as fast as they want to. If you think this is a bubble, bro, if these guys were getting all the energy they needed, you would see a bubble. Nvidia would probably be at 250 right now if it wasn't for that. But that's good and it's healthy because it allows us to digest everything that's happening here, unlike what happened in the internet bubble, right? We get to digest this as it goes along while we wait for the energy infrastructure to catch up to the demand in the marketplace. KRMD chart. There it is. We have a CEO change. People are actually excited about it, from what I hear. They reported their quarter. Advising, I didn't advise, I'm not an advisor. Saying that I was getting out of the stock was probably a good message for everybody to hear. Not to mention the fact that as you go into the technicals, hopefully I'm not freezing because this is freezing. Let's see. No, I'm still good for now. For some reason, my app is... Come on. All right, we can zoom in. Right? From a technical standpoint, I don't know why my mouse isn't working. We were at the high end of the range here, right? And as it got to the low end of the range, I didn't come in and say, yeah, I would be buying this here. Why? Let's see what's going on. All right, good, we're back. We can zoom in on the technicals. Why I didn't say get back in here was quite simple. It's a simple dynamic. The outgoing CEO is known for being very conservative in her guidance. And what she does is she gives her guidance for the year at the beginning of the year, and it's extremely conservative. It's what happened last year. We go back to the charts, you can see that the stock got smashed last year. Smashed. Why? Because her forward guidance for 2025 was so weak that people just thought there was something wrong with his business, and it just completely fell out of bed. It wasn't weak. It was conservative. She was giving a number that she could easily hop over, that she could easily beat and raise and beat and raise and beat and raise. And what they did was, in Q1 they beat and raised, in Q2 they beat and raised, in Q3 they beat and raised. And after they beat and raised in Q3 and the stock was up here at these levels, I said, that's it for now, because what comes next after the beat and raise and the beat and raise and the beat and raise is the Q4, which will be the beat and new guidance for 2026. And as we know from 2025, she issues weak guidance. And so we got a repeat of that right here. Okay? This is what the chart looks like. And as this market settles out, this is not a bad level for KRMD. Okay, for those of you who like the stock, if you're afraid of the stock market, hedge the stock market. Don't sell your shares if you own shares here. If you don't own shares, would I buy some here? Well, I haven't yet, but it is starting to become tempting because the dynamic that I described is in the rearview mirror, and now we should get beat and raise, beat and raise. It's just that we're not going to get that first beat and raise for at least a month from now, and the market's obviously acting poorly, continuing lower as we speak on today's show. All right, so hopefully that helps. And let's move on to the next question. Let's see what we have here. Gatekeeper. Tell you what, let's talk about Gatekeeper, since we're at a Gatekeeper question and I got a Gatekeeper on the screen. Two pieces of news. Gatekeeper announces basically $1 million new contract. All right, good. Enough said about that. Okay, good news. What? There's nothing more I can say about that. If there's something strategic, I would tell you. In fact, this wasn't Gatekeeper news, right? They didn't put a press release out about this, nor should they, because it is regarding the MTA, the New York subway system. And you see in the New York Times that the MTA aims to replace thousands of aging subway cars built in the 80s. Okay? Well, whoop-de-doo, Mark. Whoop-de-doo. Those are new trains. And last time I checked, Gatekeeper doesn't make trains. Yes, stupid, but they make surveillance equipment for the trains. Money Mark, you're stupid, because a train doesn't need surveillance equipment. Okay, stupid, that's true. Except if you've been paying attention, dummy, the governor of New York has basically made it mandatory for all new trains to have surveillance equipment on it. Well, that doesn't mean that Gatekeeper... No, it doesn't. It doesn't mean that Gatekeeper is going to win all that business. No. But they did win the Long Island Railroad contract. And I told you back then that put them in the driver's seat, because if Philadelphia told New York to use Gatekeeper and New York starts using Gatekeeper, yes, only in Long Island, what do you think they're going to use in Manhattan? To me, they're in the driver's seat. And some people in my community made a great observation, which is, well, only if Alstom wins, because Alstom's their partner. If Hitachi wins, these are train makers, Hitachi and Alstom, then it's not good for Gatekeeper. Not necessarily, Jack, because just because Alstom is currently a partner doesn't mean that Hitachi won't be a partner in the future. Wink, wink. You got to put the dots together, y'all. Okay? So this news is much more interesting to me than them winning $1 million deal. Doesn't mean that I want to jump in and buy more to increase my position of the stock now. I've been waiting. And yes, the risk reward chart has gone down 3 points. So if if you use the 3-point rule on the way up, then you took a lot of profits on the way up, and congratulations, because that was the right move by far. Stock topped out at 220, is now at 85 cents. We were in here. 30 cents is where I said buy. Back here is also where I said buy. You see the green arrow there, right? And we, boom, doubled our money, tripled our money, take some profits, quadrupled our money, right? Up here, we're 7 bags in. Take 6 off the table, stupid. We're really close. I don't think the red line wasn't there at the time. The red line was a little bit higher. I've adjusted it lower since. All right, just to provide some margin of safety, just so people will know in the future, because a lot of people were just like, to the moon. No, not to the moon. Take profits along the way so you don't lose all your profits, right? I gave it to you at 30 cents, but if you didn't catch on to it until 85 and rode it to 220, you pretty much tripled your money if you didn't take your profits off the table. If you go from 1 to 3, put 2 in your pocket and keep the 1 there if you want. Then you can't lose. You locked in, doubling your money. You spent 1, and now you have 2 in your pocket, and you still have 1 in the stock. But then it pulls back to 85 cents, and you're back to where you started from. You've made no money. Okay? Not only that, but you've had that money sitting there, making no money for over almost 9 months, where it could have been making money somewhere else. Okay, cool. All right, so it gets up here. Let's say you follow the rules. You've got your notebook, your pen, you follow the rules, and the stock starts dropping, and you say, all right, it's dropped like 3 points. I'm going to buy some more. That's cool. I ain't mad at it, right? I bought some more on the way on certain aspects, and then it broke the technicals. You see the technical analysis comes into play, and it hurts people's mentalities and all that stuff, and the stock starts falling, and I'm like, and then the Iran stuff comes in, and we got the yellow alert and all that stuff, and it's like, do I want to buy more Gatekeeper at these levels? At what point will people stop panicking? Because the fact of the matter is, people panicking is good for me. I'm not going to come here and make people panic. That would be manipulation. I'm not here to manipulate. I'm here to tell the truth. Bullish or bearish, I'm here to tell you all the truth, because I don't like what colleges do, putting you in great debt and letting you graduate with information that doesn't make you a millionaire. It hurt me. And I don't like CNBC because they're only there for your advertising dollars, right? I'm here for the truth. That's what keeps me here, is to save you from these two entities that rob you every day, every year, and the 10,000 clowns, of course, that do the same. So I'm not going to spark a panic, right? But I'm not going to stop it from happening because, shoot, I get to buy more stock at a lower price. That's not a message for you to sell your shares. Otherwise, I would have sold all my shares before telling you this. But I think that would be dumb, because this is a position in my portfolio, and I think it belongs in the portfolio because of nothing's changed in the business. Are they going through a rough patch right now? Maybe. Getting ready to ramp up all that business that they got last year? If you want to call that a rough patch, right? They're a little quiet. Well, yeah, because they signed tens of millions of dollars of business, and now they have to get ready to fulfill it. And in the meantime, things go quiet. So what? If people freak out about that, good. Let them. Because then we can buy more at a cheaper price. But if people stop panicking and the stock starts to rip, I don't want to be mad at myself for playing games by getting rid of my shares. By the way, so what am I looking at? It broke the technicals. It broke $1 in the US, and it's heading towards $1 in Canada, which would coincide with the breakout that it had back here. Maybe that's where it bottoms out. Maybe this is where it bottoms out, though, because you see, if we zoom in on the chart, what you see is, right, it's very much the lower end of the range. It has definitely, right, and what you do is look at the moving averages, the blue being the 200, the red being the 50, and you see how far the stock strays from the moving averages. And as you can see is when the stock strayed this far from the 200-day moving average, it bounced. and then it continued lower along with the 200-day moving average, and then collapsed. And look, it got this far from the 200-day moving average, and you could actually put a line here. Get the 200-day moving average is moving down like this, right? And then here, look at that. How magical, right? When people panic too much too fast, the stock bounces. When people panic too much too fast, the stock bounces. Panic too much, bounce. Panic too much, bounce. Panic too much. What's next? Maybe bounce. I'm not going to play that quite yet. I've got enough of the stock. Maybe I should. I'm going to actually write it down and consider it over the weekend, because maybe I should trade a little bit of Gatekeeper at these levels, because we've gotten a bounce so many times. It hasn't been a 50-50 bet. It's been almost 100% bet that when, boom, boom, we get that much of a move down off of the 200-day moving average, it bounces. So if I got to guess, I guess the next move is a bounce. Let's see what's next. We're going back to Q&A. So that was Gatekeeper. Next up, ambient IoT. But while we're at it, I know we're going to run out of time. I know we're going to run out of time today, and that means I'm going to give you part of the story today on my new largest position, and probably come back Monday for the rest of it, because there is so much to talk about. I could do easily, I think I could do a whole 2-hour show on this company. Okay, and you guys, a lot of you already know what it is, I think, because I've been talking about it, on a weekly basis, and all that. I've been very careful, because this company has such a low float now, and if you look it up, you'll say, Mark, it doesn't have a low float. Yes, it does, stupid. Well, it says on the internet. Shut up. You think the internet knows? I use something called effective float. And what that means is, let's say a company has 3 million shares, 10 million shares outstanding. Let's say 10 million shares outstanding. And the insiders own 1. And nobody else of any, importance owns any. Then 90% of the stock is in the float, right? You got 100% of the stock, 10 million shares, but 1 million of those shares, 10% of the shares are held by insiders who are presumably holding tight to those shares. That means there's only 90% of the shares available to the public. Well, guess what? If insiders decide to sell, then 100% of the shares are available to the public. So who cares? So this is why I say it's effective float, because effectively it's only 90%, because we don't think the insiders are going to sell. All right. So when I look at this company and I do the math, there is an extremely low effective float. This is a very low float stock right now because of the companies that have come in and bought shares of the stock very recently. I have people who have spoken to those shareholders and what they think this company is worth. I know people that own the stock. I own the stock, and you're not going to see a lot of those shares come out onto the market. And I believe it is the majority of the shares outstanding. I feel bad for the shorts, because 10% of the shares outstanding are short the stock, and I understand why. We're going to talk about it later in the show. Let's get back to Q&A. We had the question about the co-packaged. Can you show the risk reward chart for Curie? I already showed that. And nothing's changed about the opportunity. As a matter of fact, I had a talk with somebody today on Curiosity Stream. I had it in my notebook to talk about. Here we go. Based on conversations with management, the guidance that they provided was extremely conservative, largely based on revenue that they feel they have in the bag. Does that mean they can't miss? No. But they were conservative, and they feel that most of what they guided to is already in the bag. That gives you a high degree of confidence. That means it's a much better than 50-50 bet that they're doing good right now. Okay, relative to the guidance they gave, relative to what has caused the stock to get to where it is right now, because people didn't like the conservative guidance, just like what happened to KRMD, right? But that creates opportunities. Not only that, but partly because of what you're seeing with the Tom Cruise Brad Pitt video, the hyperscalers, right, want more video content. And CuriosityStream is not only an owner of video content, a processor of video content, so it's LLM ready, but also a middleman, a broker for other companies that want to do deals where they provide their video to the hyperscalers to train AI on how to make video content. That's how it works, right? If in an ultimate case scenario, if there was one LLM, if I could start a company called MoneyMark AI and build a giant AI data center so big, right, and could magically Wanda, the Scarlet Witch from Marvel, snap my fingers, Doctor Strange, create a portal, and suck all of the video content ever into my AI data center, very soon after that, I would be able to make the next Avengers movie just by prompting, right? Telling the AI what to make for me. That's where we're heading. But we're not there yet. And you know it if you've played with video on AI, if you've gone to, there is what is that social media platform? I forgot the name of it. Good Lord. Sora. Right, if you go to Sora, it's all AI generated content, and you know if you've interacted with this AI video content that sometimes it's cool, sometimes not so much. They're not quite getting it. That's because it's learning. The AI is learning how to make great video, and it can't learn unless it has more video to learn on, to be trained on, and that's what CuriosityStream is enabling with their own content, with the content that they broker for other content suppliers, and the fact that they have their own factory for taking that content, all that video content, and you have to manipulate it in such a way that it is helpful, ideally helpful for the hyperscalers. Okay? That's what they're doing. So you have to assume that business is good because of what we're seeing and what's happening to AI. Right? And as a result, and this is big. This is maybe the biggest thing. Where are all the best hyperscalers on the planet? In the US. Do you think the United States is the only country in the world where you've got entities that want to have control over an LLM or LLMs or hyperscale activities? We know China does, right? So, and if China wants to train their LLMs on video, then they need video content. And who produces more video content than the United States? Bro, you might need 1 million hours of video content to do a decent amount of training. And CuriosityStream charges between $25 and $1,000 an hour for content. So you can do the math. $25 to $1,000 an hour for the content that they provide. And some of these frontier models need excess of 1 million hours to train on. So for those of you afraid that, well, maybe Google is trained on the video as much as they need, which is stupid. They haven't. You have more and more new hyperscalers coming to market. And what's happening to Anthropic is going to encourage new companies in new countries to form new hyperscalers, to build new LLMs, to build new frontier models, and those models are going to need to be trained also. I'm bullish on CuriosityStream. It remains one of my largest positions, and I don't care what the stock has done, frankly, because the fundamentals have only gotten better. We got a question regarding WATT. Stay tuned. At these levels and with it being an AI-centric company, have you considered taking a second look at Amplitude? I mean, I never stop looking at a company that's within my wheelhouse, and Amplitude is within my wheelhouse. But if you listened, if you had your notebook out, when I removed amplitude from my priority coverage area, right? You heard that I thought that they had some issues internally, and then since then, the whole software AI is killing software narrative has imploded a lot of stocks. Stocks down to 7. It was up around 12 when I got out, when I talked to you about that. And it hasn't gotten to the point where it has restirred my interest. All right, so that's where we stand with that. Let's see. Yeah, more on WATT. We're going to talk about WATT. I just want to do some Q&A now, because if I start talking about WATT, we're going to run all the way to 4 o'clock. The show's going to be over. I won't be able to do Q&A. It's much easier for me to do the Q&A now, and then at some point say no more Q&A. We're going to talk about WATT for the rest of the show, and if there's overflow, then I guess maybe I come back Monday morning and give you the rest of the story, because there's really I could go on for 2 hours, and I'm only going to be able to go on for maybe 15 minutes today. So let's see, GDXJ chart, amazing, right? Bro, this has to be one of the best charts I've ever put in front of you guys, because this is not what the chart looked like when I gave it to you. It looked like this. This is what the chart looked like when I first showed it to you, because this is when it was. It was a year ago, right? Is that right? Yeah, it was a year ago that I showed you this chart just the way it looks right now. And I said, and I quote, "There are only 3 times in history before right now." This was a year ago. "There's only 3 times in history before right now, since 2010, where you had gold going up and oil going down." Okay? And GDXJ, for those who don't know, is the junior miners ETF. Junior miners being small gold miners, basically. Okay? And how do gold miners make money? They pull gold out of the ground and then they sell it. So what's a big determinant of how much money they make? Gold prices. So if gold prices are up, that's good for them. Great. But what's the biggest expense? Oil prices. So if oil prices are up and gold prices are up, it might be a wash. It might be neutral. It might even be bearish for a lot of the junior miners. But if gold is up, then revenue's up. And if oil is down, then expenses are down. And when revenue is up and expenses are down, it's absolutely explosive for the bottom line. And only 3 times since 2010 had that occurred. And this and this and this is what happened to GDXJ when that happened. And the 4th time was when I told you right here, it's happening again. Gold is going through the roof, but oil is going down. And GDXJ did this, and the rest is history. That was a lesson. If you don't, I didn't say that just to toot my horn. That was easy. That was one of the easiest trades ever for me and you. With management, how do you analyze credibility and trust? We don't. I'm sorry, that's a phenomenal question, but I don't answer questions about my method, my research process. You can learn a lot about that on the internet and YouTube and all that, and go learn about, read some books. Warren Buffett has a lot of stuff out there on how to become a great stock picker. Okay, and you should read that stuff. And then you'll learn the rest from me here. Right? I skip that stuff because how you analyze management is well-known industry stuff that you can learn from anybody. What I provide here is the stuff that you can only learn from me, pretty much. Looking for question marks at the beginning of the questions. Does IZEA's cash place them as a target for another buyer to acquire them? No, the cash doesn't. The business does, right? The cash probably makes it tougher for somebody to buy them, because why would IZEA sell out for $3.60 when they have $3 of cash? IZEA is not. There's no way, okay, 99.999% sure that IZEA is not selling itself anytime soon anywhere near these levels. Okay? Should we avoid OPTXW and just focus on OPTX? Oh, man. That's a loaded question for me because I just said I wouldn't teach you principles that are well known in the world. But I'm going to make a semi-exception here because this is what you need to know. OPTXW, I don't know if I have a chart for that. Yeah, I do. Okay, these are the warrants for OPTX. A warrant is basically a stock option. As far as I'm concerned, it's a stock option because the warrant has a strike price, I think 11.50 in this case. It has an expiration date, about a little over 2 years from now, if I'm not mistaken, right? And there are plenty of what is known as options valuation calculators out there. Most specifically, Black-Scholes is what it's called. Okay? A Black-Scholes calculator is an options calculator. And you put in the stock price, the exercise price, that 11.50, the time to maturity in years, the 2 whatever point whatever years, the annual risk-free interest rate, currently 4%. I showed it to you earlier. It's right here, right? And then annualized volatility. That's the most difficult one to answer. And for a volatile stock like OPTX, you can put in 50%, right? And if you do this enough times, what you're going to find is that this will calculate the value of the warrants, okay, based on a certain volatility number. I would use 50, okay? Just speaking from experience, I think 50 is the appropriate number. You can fill out the rest and see if the warrants are worth buying or not. That's the answer to my question. Relative to the stock, right? Because that options calculator said input stock price. So it's going to tell you what the warrants are worth right now based on what the stock is worth right now. And the only difference is that the stock is going to run into some trouble getting above 12 for a while, assuming it gets to 12. I've already said that I think the stock is should be closer to 12 than 6. And here it is at 6. So you can guess what I'm doing with the stock right now, right? Either holding or buying. And then you can decide based on what the warrant calculator tells you if the warrants are worth buying. Just know that the 50, maybe the 50 should be 40 as a result of the fact that the warrants won't be able to continue to go higher and higher and higher rapidly. Once the stock reaches 12, it's going to take a little longer to get to 14 and 16 for reasons I've discussed in the past. Okay. We're running out of time. We're going to go into lightning mode so that we have enough time to talk about WATT for the remainder of the show. And then I guess we're going to have to maybe come back Monday and continue the discussion, as I said. So let's see. Can OPTX capitalize on LEO optics and laser comms as orbital data centers rise, or is it just space hype? No, that's real, bro. I would love to see a full report done by Rob Mock and his colleagues. Maybe Rob, if you're listening, maybe you could take all that information that you gathered. You know, the great thing about AI is when you gather information, you could feed it into AI and feed it into AI. And yes, AI can go out and find information for you, but you find your own information, you feed it into AI. If you have a whole conversation of months and months of conversing with AI where it's finding stuff for you and you're finding stuff for it, then what you do at the end is you say, please produce a report summarizing everything that we've discussed over the last few months. That would be phenomenal for everybody. But to answer your question, I've shown you the model that Rob Mock produced. And yes, absolutely, that's baked into his model. It's assumed It's not, can this be a plus for OPTX? No, it's absolutely, like, I am 99.999% that OPTX is going to be making a lot of money off of these satellites. And data center in outer space, yes, 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 and yes. Next question. After that great call you made on Himax over 10 years ago, have you ever considered revisiting the stock since there are rumors that it is a key supplier to Nvidia and Apple glasses? Well, to answer the question, yes, I've considered revisiting it, because once I know a company, then I can continue to use that information. What he's talking about is back here when I made it a buy at $3, sold it $9. It continued on to 16 as Wall Street pumped the stock. Yes, Wall Street pumped the stock. Almost nobody was covering the stock appropriately back here. Okay, and then I came out with, just like I did with TSSI, I became the first person to prove that Himax was designed into Google Glass, which never came to market, but there was a lot of hype around Google Glass at the time, and people got hyped up over the idea that Himax could be in that. And I thought that Himax could go, to 10, 15, maybe even 20 on this news if things happened, proceeded, and Google Glass came out. But the stock went very quickly to 9. I remember the day I came out with the proof that they were in Himax, the stock went berserk. I got calls from institutions. I got put in the newspapers in an article next to Mark Andreessen and all that stuff. And it went on, and CNBC actually named it the best performing stock of tech stock of that year. But then Wall Street jumped on the bandwagon up here in the teens, like typical Wall Street, right? They're not there to tell you to buy at 3, but they're there to tell you to buy at 12. Jumping on, this is a buy rated stock. Stupid. Boom. Right? And the stock tanked, got down to 6, and then got downgraded to a sell by Shard and Capital Markets, basically calling the bottom in the stock, because it didn't spend more than a few months. Over the next few years, it only spent a few minor months below that price. This is what Wall Street does to you. See? CNBC, Wall Street reports, college, the 10,000 clowns on social media. You cannot trust any of them, because all of them are out for themselves. I don't need to be here. I made 40% a year before I ever wrote a Seeking Alpha article, before I ever had a public pick, and I'll make 40% a year without it. Why? Because I don't need anybody for my stocks to go up. All I need is for my valuation analysis to be correct, and it will go to that valuation, because that's what stocks do. That's why Warren Buffett isn't out here pushing his stocks. Stan Druckenmiller isn't out here pushing his stocks. They can make a lot more money. They can make $1 billion a day pushing their stocks. But they don't, because they don't need to. Because when you're a real analyst who knows how to make real valuations, not all those clowns I just talked about, you don't need anybody to get rich. So you can do it any way you want. Lightning round. Last questions for the day. In fact, this is the last question for the day. Thoughts on OPTX? Could it catch a bid with the Iran macro, or also you researching other photonic stocks? I research stocks that make sense for me to research. So yes, I already gave you my thoughts on OPTX. And could it catch a bid with the Iran macro? Go back to the macro portion of the show. Right? Because if the stock market starts going up, that's usually helps all companies, right? So if you're talking about that, you could ask that question of any stock. Could ABC catch a bid with the Iran macro? Well, if the Iran macro turns positive, then the answer is yes. All right? Put that in your notebook, please. And I don't mean to be mean. It looks like a first-time question. So, don't take that the wrong way. I'm a really tough professor, okay? I'm Coach A-hole. That's my nickname, Coach A-hole. So, he didn't come out too much today. I did give some people indirectly the dummy treatment, but that wasn't really the dummy treatment. All right, let's see. There's one ticker symbol we won't get to today, but we gotta save some time for WATT, which is going to have to spill over into next week. Whether it's Monday, Tuesday, Wednesday, or all of the above, we'll see. This is good. Okay. So actually, let's start here. I showed you this report weeks and weeks and weeks ago. I wanted to give all you good students out there, all you people that have been with your notebooks and your pens, learning from Money Mark, because that's what I want you to do. I want you to learn from this. That's my goal, is to teach you this, partly because that's what made me rich. Somebody had the goodness of their heart to teach me how to become a millionaire. That's what I want to give back to the world. And what's great about that is my teachers now benefit from my picks because they taught me to become a monster like them. So now they find their monster picks, I find my monster picks, and then we share monster picks, and then we put together a whole portfolio full of everybody's monster picks. So you get great diversification and you find more winners. All right? So, and yes, I have met new research partners because of this show. Right? And so I wanted to reward the good students with the ability to figure out what this meant. That there's an explosion in ambient IoT and physical AI in the supply chain because the little sensors that they can put everywhere, RFID chips, all that stuff, right? You could put a little sensor on a pallet of lettuce and it will monitor the temperature, the humidity, the location, all kinds of things with regard to that lettuce to make sure it doesn't spoil from the farm that it gets picked from all the way to the grocery store where you end up buying it. And trust me, that's a long trip because it doesn't go straight from point A to point B, right? It goes to a warehouse like Walmart, right? So if Dole or Del Monte or whatever makes some lettuce, they send it to a warehouse of Walmart. Walmart sends it to a distribution center. Distribution sends it to a Walmart store, and then it gets sold at the Walmart store. All that lettuce could go bad from point A to point B, and then Walmart not only doesn't make a profit, they lose a boatload of money. They lose all the money that they spent buying that lettuce, and the time, and the labor, everything else, right? So you put a sensor on there, and the sensor keeps track and makes sure that the temperature doesn't go above a healthy level for that lettuce to stay healthy until they can sell it to you and me, right? The cost of these devices were measured in the dollars when I was in the industry. I left my last job in 2004. I joined them in 1998, and back in 1998, Walmart was a customer and trying to figure out how to put RFID tags on everything so they can monitor the movement through the supply chain, okay? Fast forward to now, and you can put sensors like that on that pallet of lettuce for less than 10 cents. That's huge because there are literally maybe billions of items that you would want to track with a sensor. You can't do that economically at dollars per sensor, but you can do that economically under 10 cents per sensor. And the final step in that process of getting those sensors down to like a dime or a nickel each was to remove the battery. It was part of the cost, and it was part of the headache, because what happens when the battery dies? Who's going to change it? Who's going to recharge it? This is a pain in the ass, right? So what happened was that you had the sensors became super cheap, which made it great to use. They took the battery out, right? And I missed a step. The sensors got cheap, but at the same time, AI became exploded. The ability to take all that data, right? Monitoring lettuce from point A to point B, days, every second of every day, monitoring the data, uploading that information into the cloud is a tremendous amount of data, right? And it's a tremendous amount of data to process. So you need tons of storage, which was more expensive in 1998, and you need tons of processing power, which was more expensive in 1998. And then ideally, you would have somebody to analyze all that data, a data scientist. Oh, but guess what? Now AI can do it. And so the cost of uploading that data and analyzing it has dropped as dramatically as the price of the sensors themselves. So it's the intersection of two major forces. And then add in removal of the battery, and now you've got companies going ham. Walmart, very well known, it's very public out there, that WATT Watt has a major engagement going on right now through its partner Wiliot. Look at that. It actually brought up Wiliot, Walmart, IoT sensors. Look at that. Wiliot, Walmart, and the future of physical AI. That's what that's called. You can go look this up yourself. It's 1L, Wiliot. Okay. When Wiliot removed the battery in their Gen 3 sensors, which were only released several months ago, that's what introduced the WATT opportunity. Because how do these things get power? If you put something that literally looks like a sticker, okay? Every dentist makes these things. It looks like a sticker, and you put it on the pallet of lettuce. Costs you 10 cents. This little sticker there's really electric infrastructure on this little sticker-sized thing. And as long as it has power, it will monitor the temperature, the humidity, etc., right? But if it doesn't have power, it won't. Well, that's where Watt came in, because once the battery was removed, what the Gen 3 devices from Wiliot do is, in the presence of a Watt box, right? The Watt box sends energy over the air. Over the air, just like Wi-Fi. Wi-Fi is data over the air, so don't be surprised that energy can be sent over the air in safe quantities, right? Not enough to charge an iPhone, but enough to power a little tiny sticker-sized sensor, all right? And when you do that, in the presence of that box, the sensor turns on automatically and says, oh, there's energy in the air. I'm on. Oh, this is the temperature. Oh, this is the humidity. This is my location. Send it upstream into the cloud to be analyzed by AI. How does that happen? Through the Energous box. The Energous box not only sends electricity downstream to these sensors, it collects the data from the sensors and sends it upstream into the cloud. Let's say AWS, okay? Because that's going to be part of this story, assuming I have time to talk about it today, which I probably won't, but so stay tuned. And what ends up happening is, in the cloud, that data gets processed, not by a human, but by the AI. And so what happens is, if, let's say, there's a truck with that lettuce in it, with that sticker on it, and that sticker starts to notice the temperature rising above the temperature that's safe for the lettuce. It sends a message to the Energous box. The Energous box sends it to the cloud sends it into the database gets analyzed by AI, and the AI says there's a problem on this truck with this lettuce. Send a text message to the driver saying what the F is going on. And the AI does that with no intervention. This is what I'm telling you, like this is how the future of how this is gonna look, right? The driver pulls over at his first chance, gets out of the truck, goes out back and notices, oh shoot, they forgot to close the truck properly, closes the door, locks it up, boom, 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 right? And sends a text message back to the AI and says everything should be good now. And the AI checks and sees that the temperature starts dropping because the refrigeration unit in the truck is starting to cool the air in the truck, and it's not escaping out the back of the truck. And everything's good. A whole pallet of lettuce is saved, and the only thing it costs Walmart to do it is the truck driver to pull over for a minute and close the door. No other intervention, no other cost. This is going to drive tens of millions of extra dollars to the bottom line of Walmart. And that's just one company. Okay? Energous announced preliminary results on January 13th. They will be reporting results very soon, I would say next week. Okay? Don't be surprised if in the next few days, Monday, Tuesday, Wednesday, Thursday, one of those 4 days is a very strong bet for their earnings to be announced, because we're at the end of the cycle where the 10K has to be released. And that's important too, by the way, because the shorts out there, I feel bad for them, because I understand why they're short Energous. They think it's a pump. It's got an ATM. All they've ever done is raised money. Let's bring up the chart. This was a horrible company. I actually passed on this company years ago. I was like, this is a horrible company. This company is just going to go down forever, because there's no way that you can charge an iPhone over the air. The FCC will never allow it, and they didn't. But they did allow something, 2 watts. Do you know how many watts you need to charge a sensor that I've been talking about here? 1. Oh snap. This thing can charge sensors. So all of a sudden the blind squirrel found a nut. This horrible company that was on a collision course with going nowhere forever finally found a use case that's actually good for them. And as a result, they're now getting the business of Walmart. And what does that mean for them? And let me show you. And then we're going to call it a day, because it's already 4 o'clock. We're going to have to save the rest of this for next week. And it's just, like I said, it's just hours and hours of information I can share on this name, because I've been doing it for a long time. I just wanted to give you guys a chance to find it yourself. And some of you did. Some of you did and got into the stock cheap. Congratulations. You see how the stock has been acting. This is, in my estimation, not unjustified. Okay? And you can tell based on the information I'm giving you. Right? And as soon as I started talking about Watt, I put myself on a 72-hour embargo from that moment. Okay? The second that we started talking about, what was it, at 3:50 p.m. As of 3:50 p.m., I am embargoed for 72 hours, at least. Look at these results. This is what I want to leave you with, at least for this week, because I just gave you the great story of the use case. Okay? I got a lot more information to share, but we got to save it. But let's close the book on this particular piece of the equation. 1, this is their annual revenue going back 6 years. 5, that's 500,000, folks. That's 0.5 million. 500,000, 200,000, 300,000. Bro, I had multiple 7-figure businesses. I've had multiple businesses way bigger than what Energous was in 2018, 19, 20, 21, 22, 23, and 24. Okay? But then there's this thing called LTM. What's that? That's last 12 months, also known as TTM, trailing 12 months. And it spikes, you see, to 3 million. Why is it that there's a company, why is it that this company could never make $1 million of revenue in a year, but suddenly in the trailing 12 months, it spiked to 3 million? Well, simple. The blind squirrel found a nut. The Gen 3 devices for Wiliot, which, by the way, is just one of their many partners. We'll talk about more in the future. Gen 3 made Energous basically a requirement for those sensors to work. And so all of a sudden, Energous started getting automatic business. Okay? No extra spending on sales and marketing or R&D. Because as you can see, they actually spent a lot less. They've been dropping SG&A expenses. They've been dropping R&D expenses. Why? Because they were chasing a pipe dream. Now they have a new CEO who realizes that we shouldn't be spending all this money. We need to get our break-even point down to something reasonable, which is, she's done a wonderful job of doing that, continues to do that job of doing that, so that they can break even at a reasonable level coming soon, right? And then simultaneous to that, because of those Gen 3 sensors, they start getting business. So they go from making less than $1 million a year to making $3 million in the trailing 12 months, the last 12 months that they've reported, the last 4 quarters combined, to $3 million. But as you can see, this press release says that they were planning on revenue of approximately $3 million just for the 4th quarter. So they went from less than $1 million a year to $3 million in the last 12 months to $3 million in the last 3 months. which means that they're very likely going to do in excess of 15 million for the year, which will be, I mean, the comps are going to be ridiculous because with the $3 million for Q4, they're going to finish the year at like 5.5 million. And then if they do, let's say 16.5 million this year, that's going to be triple digit growth, 200% growth. So the next, after, in fact, starting with this quarter, when they report these numbers, it's going to say revenues of, I don't know, whether it's, they said preliminary 3 million. So 2.9, 3.1, it doesn't matter. It doesn't matter, right? Compared to the year ago period. You know what they did in the year ago period? I'm going to bring it up. Come on. Takes a little while sometimes. Here you go. Q4 of last year, 0.43. If they come out with 3 million in revenue this quarter, that's 7x last year. Energus reports Q4 revenue of $3 million, up 700%, 600% versus Q4 of last year. And then next quarter, if they put up another 3 or 3.5, because it looks like they're going to grow. The Walmart rollout is going to take place over the course of basically the whole year. One customer, one Fortune 500 customer. Okay? And they have more. We'll talk about that in the future. But another 3 million, and it's 1,000% growth. Boom, boom, boom. Multiple hundreds of percents of growth that you're going to see quarter after quarter, and improved movement towards profitability. Decreased losses towards profitability. All right? And that's what's going on here. And that's where I'm going to leave you today. And with the, and I'll leave this here. Oh, what is it? This one. You want to look this up. Okay? Because this is a good overview of the company, so you can do some of your own research, a more complete job of it. That's just one company. And it's not the only one, because this is something the industry has been waiting for a long time, and that's why I showed you this report. This is the inflection point where the collision of sensor prices and AI processing capabilities inflect or come together to create a massive inflection in the demand for the kind of solution that I just described for you with the lettuce. But now you can apply it to virtually anything that travels through a supply chain, whether it requires temperature monitoring or not. So that's it, my friends. This has been the longest episode in a while, but I told you it would go long. I'm glad I did it the way I did it, because I got to answer all your Q&A as I try to promise to do every week. We can always save more of this story for future episodes. Boom. Like, subscribe, hit the notification bell. That's about it. I'm going to go play with my child, kiss my wife, have some lunch. Have a great weekend, y'all. We'll probably be back next week. I don't guarantee anything. I'm a retired guy. I'm here to help you guys out, but not on your time, on mine. It's Friday. It's Money Mark. Stock Talk Live. Catch y'all next time. Bye-bye. And sorry for y'all, I didn't get your question in at the end. That was the last question. Save it for next week.